All right, today we are going to go through the four major mutual companies and their 2022 dividend interest rates that will be applied to whole life insurance policies. So we're going to cover the updated dividend rates and a whole lot more. Let's have some fun. So when it comes to the four major mutual companies, we've got them listed here in no particular order, being Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Now, why these companies are considered the four major mutual companies, as this is an industry-wide term, there's a number of reasons. I'm going to cover 4 reasons for your 4 major mutual companies. The first reason, company size. If you were to look at their company size, especially relative to other insurance carriers out there, they are massive. Now, there are other stock companies such as Prudential that are quite large as well. But again, remember, 4 major mutual companies. They are all mutually held companies, meaning there are no stockholders involved. So number 1, company size. Number 2, financial ratings, specifically talking about the financial strength and safety ratings. If you were to look at the company's Comdex score, which takes all of the ratings categories and almost gives a grade to an insurance company, each of these 4 companies range between a 98 and 100, with, of course, 100 being the highest. Number 3, how long they've been in business. So all of these companies have been in business for over 160 years, dating back to the 1800s. That's a long time that they've been in business. But then the 4th reason, which is really the biggest selling point in my opinion, is when you look at actual policies, real whole life insurance policies, which would relate to you as a consumer. If you're looking to take out a policy, what company is going to give me the best results in my money, where I'm going to see the cash value actually grow over time, not just project good numbers, but actually deliver. What I've seen to be so consistent is these 4 major mutual companies have delivered the strongest cash values. When we look at actual performance, we've got a historical performance study that takes a number of policies with several companies, not just the 4 major mutuals. We've seen the big 4 consistently deliver between a 4 to 6% internal rate of return. That's the net growth rate. However, to set expectations properly in the low dividend interest rate or low interest rate environment we're in today, I would expect the policy to produce, if it's designed properly, I would expect it to produce somewhere between 3 to 5%. You see banks, corporations, and wealthy individuals. When you look at what they do with their money, they position it with the 4 major mutual companies. I've mentioned a couple times before that the largest client our company has that we work with, I work with them personally, is a bank. That bank has purchased high cash value bank-owned life insurance on 2 separate occasions. On both of those occasions, they used the major mutual companies. The first time it was Mass Guardian, the second time was Mass Guardian and New York Life. And that was not because I simply recommended it. Banks do their homework and due diligence, and so do the wealthy and corporations. The reason why, actual performance, not just projections. It is critical. So those are the 4 points, if you can recall those. Moving on, their actual dividend rates for 2022 compared to 2021 have not changed one bit. When we look at Mass Mutual, you've got a clean dividend interest rate at 6% flat, Guardian 5.65, New York Life 5.8, and then you've got Northwestern Mutual at 5%. Here's something I want to add, and it kind of ties into the actual performance piece, is when we see these different dividend rates or illustrations on paper, different companies project different cash value and death benefit growth over time on the non-guaranteed side of an illustration, which has to do with their current dividend interest rate. What I will add, and this is something I've believed in really once I saw the actual data and proof behind it, is the dividend rate doesn't matter a whole lot. Not when you're selecting one of these companies. If all things are equal from a policy design standpoint, meaning I'm paying in $10,000, let's assume I have a minimum $1,000 base premium, I plow the other $9,000 into PUAs, maximizing the cash value. If all things are equal, I can literally close my eyes and pick one of them out of a hat, and I can't go wrong. We've seen too much consistency with these companies going back and forth with respect to who delivers the strongest actual internal rates of return, which is the net growth rate. Remember, the dividend rate's a gross rate. We touched on that in other videos. But when we look at the actual performance over time, they go back and forth with each other. So you really can't go wrong with any of these companies. That's my personal opinion, which is really based on facts and data. Now, what will help refine one's decision-making process really comes to PUA flexibility. Meaning, if I want a high cash value life insurance policy, if your goal is to pay in, call it $10,000 per year, let's use a nice round number, and this could be also $1 million per year, just take a zero off or add a couple. Say it's $10,000 per year. And you want a policy where you can commit to the minimum, have the ability to add more funds at discretion. What you could do with each of these companies, if you design it properly, you could literally have a $1,000 minimum premium. That would be your actual commitment. Might be a little bit higher than that. We'd have to add a term insurance rider in this case, so it might be $1,200. My point is, how do I commit to the minimum and then have the flexibility to add more PUAs at my discretion? Meaning if you want the ability to pay in $10,000 per year to a whole life insurance policy, being that safe, liquid, tax-free area to position money, but you don't want to get a bill for that because you don't know if you could swing it each year. And the same would apply if you're paying in this number. So a lot of people do this. I think I can pay in $100K per year, but again, I don't want to get billed for that. How do you set it up properly? Well, now, using the 10K example, you can commit to 1,000 and add additional funds into PUAs at discretion. Here's where the difference comes in with the different companies. All life insurance companies, not just the major mutuals, have different rules with respect to their PUA flexibility. Give you a little bit of information here. So, Mass Mutual, for example, has a couple different rules when it comes to adding funds into PUAs. If you really want to optimize a Mass Mutual policy for maximum flexibility, where they work best is if you said, okay, I am comfortable and disciplined enough to make a one-time per year payment adjustment. Meaning the first year I pay in $10,000, the second year I pay in $5,000, following year I pay in $8,000. I can bounce it up and down year over year without any underwriting if the policy is set up properly. They've got several different PUA riders. They've got their scheduled additional life insurance rider, their planned additional life insurance rider, their LISR rider, which is very, very important to build in maximum flexibility. But the one thing to be aware of is that one time per year payment adjustment on the policy anniversary date. There are ways you can add funds outside of the anniversary date, but it is not super convenient at this point where someone wants maximum flexibility where, hey, when my premium comes due, I can bounce my payment up and down however I want. Mass Mutual works well. Where Mass Mutual also works very well is if someone says, hey, I want the ability to go with, call it a 1090 split, a minimum base premium. That means 10% of your payment toward the base premium, 90% toward PUAs, very cash rich right off the bat. And you want the ability to pay into it for a long period of time, 30, 40, 50 years, whatever it might be. Mass Mutual's products, a number of their products accommodate that type of design. So it does have to be set up properly. You've got to mech test it and all that good stuff, but they are a good company for that specific strategy. But getting back to the PUA flexibility, one time per year works very, very well with a Mass Mutual policy if one is comfortable and disciplined. Guardian works very well if you just want to have the ability to throw money into PUAs at leisure. So for example, I've got some Guardian policies and how they work is I pay my minimum base premium on the anniversary date and then 100% at my discretion, I can just throw more money into PUAs. So they're very, very flexible in that respect. I can commit to the minimum, add more whenever I want. When you look at their guaranteed cash value, it is very, very strong compared to other carriers. Now here's the thing. If I want the ability to max fund a policy, call it 10xing my base premium, it works very, very well. If I say, hey, I'm going to max fund this thing for 10 years or less. If I want the ability to just juice the cash value and pay into it for 30 years, we have to design it a bit differently or look at some different carriers. So that's just where we look at the pros and cons of each company and help one really weigh out their decision. Then you've got some limited flexibility with New York Life. You can 10x the base premium. You can add at leisure, just like Guardian. But what happens is as time passes, the first year, I can add at leisure up to 10x the base premium. The second year, it's only 8x. Then it goes down to 6x, 4x, and then it maxes out at 2x. They refer to it as their OPP, op rider. It's flexible, but at the same time, it's not. My point is, if you're a consumer, really what you want there is awareness to know what you can and cannot do with different carriers. So I hope this video was helpful. If you enjoyed it, please hit the like button, subscribe for more, and we'll talk to you soon. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.